Ladies and gentlemen, good day and welcome to the Windlas Biotech Limited Q2FY25 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touch-tone phone. Please note that this conference is being recorded. Today on the call we have Mr. Hitesh Windlas, Managing Director, Ms. Komal Gupta, CEO and CFO. I now hand the conference over to Mr. Hitesh Windlas. Thank you and over to you, sir.
Thank you, Michael. Good afternoon, everyone, and thank you for joining us today for our financial results for quarter and half year ended 30th September 2024. We have uploaded the press release and investor presentation on our website as well as on the exchanges. I hope that everybody must have gotten an opportunity to go through it. Initially, I would like to discuss the outlook and way forward for Windlas Biotech, followed by financial highlights for Q2 and H1 FY25 of the company, which will be shared by our CEO and CFO, Ms. Komal Gupta. The Indian pharmaceutical market reported a YOY growth of 8% in Q2 of FY25, with only a modest volume increase of 0.4%. Despite low volume industry growth, we are pleased to reveal another strong quarter of financial performance, achieving a revenue growth of 22% in Q2 FY25 as well as in H1 FY25. This outperformance was fueled by strong momentum in our trade generics and institutional vertical, alongside a steady contribution from our CDMO vertical. We remain optimistic about the growth prospects in our generic formulation CDMO vertical as pharmaceutical companies continue to shift business to reliable, high-quality manufacturing partners. Providing accessible, affordable and authentic medication to the semi-urban and rural markets in India continues to be our focus in the trade generics and institutional vertical. And schemes like Ayushman Bharat and Jan Aushadhi continue to strengthen the acceleration of institutional sales. For export vertical, we continue to explore more new markets to meet the growing global demand for affordable generics. We are on track for capacity expansion of Plant 2. As updated earlier, the shortlisted brownfield facility in Sailakoi, Dehradun has been acquired to meet our capacity expansion needs. Once operational, this will become our Plant 6. Revenue generation from injectables facility is expected to commence from Q3 FY25 as production batches complete their required stability testing. The company has paid a dividend of 5.5 rupees per share, amounting to rupees 11.5 crores for FY24 in October 2024. The EPS rose to 13.97 in H1 FY25 and rupees 7.49 in Q2 of FY25, registering a YOY growth of 11%. I will now request Ms. Komal Gupta, our CEO and CFO, to discuss the financial performance highlights. Over to you, Komal.
Thank you, Hitesh. Good afternoon, everyone. Our highest ever quarterly revenue streak holds steady for the 7th quarter. Windlas Biotech remains focused on expanding our outreach, driving efficiencies and delivering high-quality pharmaceutical products to meet the evolving needs of our customers and patients. In generic formulation CDMO vertical, we have improved our customer engagement and service levels. In H1 FY25, this vertical generated revenue of Rs 272.2 crores, showing a 19% YOY growth. And for Q2 FY25, revenue in this vertical reached 136.3 crores rupees, reflecting a 16% increase compared to last year. Trade generics and institutional vertical continues to be propelled by widening of product portfolio as well as expansion of distribution network. By adding more institutions and launching new products, we have extended our reach significantly, positioning us well for the continued growth. In H1 FY25, this vertical achieved revenue of rupees 77 crores, an increase of 30% YOY. For Q2 FY25, we clocked revenue of rupees 41.9 crores, reflecting a 48% growth YOY. Our exports vertical reported revenue of rupees 12.9 crores in H1 FY25, a 26% increase YOY, with Q2 FY25 showing a revenue of 8.8 crores rupees, reflecting 35% growth YOY. Our injectables facility is yet to contribute revenue, even though its OPEX and depreciation are included in H1 financials. In H1 FY25, WBL revenue stood at rupees 362 crores, reflecting a 22% YOY growth. EBITDA saw a rise of 23% YOY, reaching rupees 44 crores. PAT came in at rupees 29 crores, reflecting a 12% YOY rise. For Q2 FY25, the company's revenue reached rupees 187 crores, reflecting a 22% YOY growth. EBITDA stood at rupees 23 crores, up by 23% YOY, and PAT was rupees 16 crores, registering a 12% YOY increase. As on 30th September, the company's liquidity position is at 200 crores rupees, despite capex of 48 crores in H1 FY25. We are excited about the substantial growth opportunities in our space and are dedicated to maintaining growth momentum across all our business verticals. That's all from our side. We can now begin the Q&A session. Thank you.
Thank you. We will now begin the question and answer session. Participants who wish to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. We have the first question from the line of Rishi Kothari from PI Square Investments. Please go ahead.
Hello. Yeah, thank you so much for the opportunity and congratulations on good set of numbers. There was some specific question as to, of course, the performance was very good and kudos to that. But in terms of depreciation, as Mrs. Komal mentioned that it is due to increase from the depreciation from the injectable business. But and we are expecting revenue from injectable from Q3. But in terms of the target that we have, that around 900 top line of 9 to 950 to 1,000 crores of top line, do we still hold to that in terms of revenue for FY25?
Rishi, sorry, we missed the last portion, last 2 sentences we missed. We heard until so injectables, OPEX and depreciation is included. After that, what did you say?
So, in terms of the revenue growth targets for, let's say, around for this particular year, we still hold to around 900 to 1,000 crores of target that we have.
Revenue growth target. I think you are asking about revenue growth target, Rishi, right?
Yeah, revenue growth target.
Yeah. So, Rishi, actually, unfortunately, we are not giving any guidance. But what we can say is that last 7 quarters, if you see, we have done very strong growth despite very lukewarm IPM volume growth. So Indian pharma market volume growth has been very low, and that's the only benchmark available in the industry. But still, we have done very strong performance. So, and we believe that there is no structural change. We don't see any structural challenges in the upcoming future. So instead of giving a target, we just want to say that we are very confident when we are pursuing with all our momentum.
Okay. In terms of the PAT level margins, this quarter, of course, it dipped to around 8.4 to 8.5%, and in general, we have around 9.5%, 9.3% of PAT level margin. So, do we still will be sustainable eventually as the revenue from injectables come?
So mainly in PAT, what we do, Rishi, is we follow a WDB method of depreciation. So that's why initially the depreciation levels are going to be high for injectables. So if you see in absolute number, the depreciation change, the broad portion of it is actually injectables depreciation itself. So on a quarterly basis, increase in depreciation expense that you must be noting. More or less, the 95% of it is actually coming from depreciation for injectables. So that is not a cash hit as such, but initial few years, the depreciation levels are going to be high like that.
Okay, so 95% right now is coming from the injectables.
Yeah.
95% of the increase.
Yeah. Okay. And in terms of the interest cost, if we say, that of course it's because of the lower base, we know that, but it drastically increased from around 30 lakhs to 1 point something crores. So any specific reason for it? Because of what exactly we have taken that?
What we actually do is we follow a discipline for internal, interim requirements. We use our CC lines instead of taking out the money that is lying in bank. So that is why finance cost is being borne. However, rest assured, the income that we have earned, which is part of other income on the money kept in investments, is similar to the interest cost that we are bearing. So that's why, as such, there is no profitability impact because of that, I would say. But there is a discipline that we want to follow, not to take out too much of money. And this is also, so the increase is also the impact basically of the capex amount that we have spent. So the outflow of relating to capex for Selakui land that we have purchased for plant 6, as Hitesh was mentioning, about 13 crores was spent for that, and the money spent for plant 2 extension that we are working on. The overall capex cash amount was about 48 crores for both of these, and the cash outflow out of these was 38 crores. So this outflow was taken care of from cash generated from our operations, the profits that we made, and for the interim working capital requirements, we have used our CC limits. So that's why you see the increase in finance cost.
Okay, got it. And in terms of the employee benefit increase, last quarter, I know that we mentioned that in Jharkhand that recently there are some regulation changes that has happened. So is this the new normal that we should consider in terms of the employee benefit expense increase?
Yeah, so this includes, of course, the injectables personal cost increase and the manpower, the minimum wages increase of 25%. That is part of this. You are right, in addition to the increments and production related increase. So this should be a good base for you to consider. Other than if there is too much of production, there is contractual manpower related some variable portion that keeps on getting added or reduced.
Okay, got it. And in terms of the brownfield expansion that we're doing, what exactly segment are we targeting for plant 6 in that terms?
Sorry, what was your question?
So the brownfield project that we are expanding in terms of the plant 6 that will be eventually set up, right? So what exactly products or in terms of segment we are looking at with that plant?
Yeah. So plant 6, which is we have acquired the land building there, and we are going to now build a oral solids capacity over there, because that is the core business. And while we have expanded plant 2 extension, we needed an additional site to be able to receive the growth and the business that we have. So it is for the core area of oral solids only.
Okay. both of the expansion are based on oral solid.
Yes.
Okay, got it. Yeah. Thank you so much for the answering the question. I'll join back with you.
Thank you.
Thank you. Participants who wish to ask a question may press star and 1 on your touchtone telephone. We have the next question from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the opportunity. So, and congratulations for a good set of numbers. So my question was on the capacity expansion, both on after the plant 6, the brownfield capacity that we have acquired, like how much cost have we spent for acquiring it, and any cost that will be incurred to refurbish the existing facility?
There is about 17 crores cost that has been incurred for this for acquiring this facility, and we are working on the capex that will need to be spent on this for having the capacities built in. So we are working on that. We expect maybe by next quarter we should be able to come back on the estimated capex.
Sure. And plant 2 expansion that we'll be doing. So how much are we planning to spend on that?
Plant 2 expansion about so there's already about 26 crores spent. We 26 plus 2, so about 34 crores kind of a capex is going to be incurred for plant 2 expansion. Total.
Okay, the total of plant 2 plus the new brownfield that we have acquired, or just plant 2, 30? Just
plant 2 expansion, about 33 crores. In addition, so out of 33, 26 crores already incurred by September end. And Selakui, so the plant 6 related, 16.5 capex already incurred, cash flow a little lower than that. And in addition to that, so up to September, this is accounted for about 40 odd crores. Now we are going to work on bringing plant 6 to a usable state. For that, the amount of capex required will come back.
Sure. And when are this plant expected to commence operation? Any timelines for that? Plant 2 and plant 6?
Plant 2 expansion, honestly, we used a few machines acquired for plant 2 expansion in Q2, some portion of it, adding them in the existing plant. Q3, it should be fully operational. So we would be completely able to make use of it for plant 2 expansion. And for plant 6, we have acquired the facility. Now we have to work. Expected timeline that we are keeping is Q1 of FY20.
Yeah. So so there'll be refurbishment and then validations. So maybe roughly around Q1 or Q2 of that's where we will end up. Also, if you note that on our presentation, we have already updated the capacity numbers for the plant 2 extension to some extent, so that
Actually, if you see the numbers of our revenue, you can see that some portion of capacity has already been added. If you multiply by 4, that is already giving us a good capacity.
Sure. And once the new plant 6 also comes into operations, can we, like, what kind of top line can we achieve at optimal capacity utilization?
As we had mentioned earlier, we want to build both. So we started working on expansion and the new facility with a purpose in mind that we want to be able to deliver revenue of about 1,000 crores with these 2 additions. That is what we do.
Sure. Yeah, and my second question was on the margins front, with injectable facility also commencing operations from Q3, and we are around 12.5% kind of margins we reported last year, and even this quarter we have reported around that. So, hopefully we should see our journey towards 14-15% kind of margins beginning over the next few quarters or next few years once this injectable starts contributing to our revenue, and of course with the your scale of operations also increasing?
Yeah, of course. The margin growth has to come in. At what point it does, we won't be, it will be difficult for us to mention. But yes, we expect a 2-3% EBITDA growth in our margins.
Sure. And on injectable front, we would already be talking to our customers, and it's a facility. I think at optimal capacity, I think we can do around 60-70 crore kind of run rate from this facility. Do you think we might also go for expansion of this facility maybe somewhere in next year, or let's say if not first half then second half?
Right now it's very difficult to mention that because we don't know injectables revenue numbers honestly.
Okay.
At what point we reach the peak capacity, it's difficult to mention. Once we reach peak and we see business avenue, surely we will go for expansion. As we had mentioned earlier, that
the space is there.
Space is already there. So we would surely go for it once we reach the peak capacities, but we won't rush it until we reach the peaks here. Yeah.
Sure. Komal, by end of this year, given our cash flows, and even with this modest capex requirement, we will still be left with more than 220 crore kind of, liquid in our hand. So, any plans of, like, how are you guys seeing, how do you want to deploy this cash with us? What are the plans for deployment? Because the capacity expansion thing, we did a small acquisition also. That also, will be taken care of by our existing cash flows only, and our the cash that we have in hand will keep on piling up. So, what are your thoughts on deploying this cash that we have?
We have been looking for the acquisition possibilities. So we are very interested to look at a dosage form expansion for our all three verticals. We are also any dosage form addition, a good facility if we are able to get. We have the cash ready. In fact, the cash that we have is not even a limiting factor. We have a good debt taking capability as well. So
Sure.
We are ready for a bigger, bigger acquisition as well. But we don't want to rush it. We don't want to be too desperate. If we see issues, we back off. The issues that we don't feel very comfortable with. That is one. However, once, by the time our injectables business is completely set, if we do not see a good fit in market, we would ourselves pick up a dosage form and build something on our own. It's just that we didn't want to do it too much on our own at the same time. So we would wait until injectables really becomes a normal part of the business. By then, either acquisition, if acquisition doesn't come through, then we would decide on which dosage form we want to build our own facility. That's the plan.
Sure. Just one last question on the...
Mr. Ankit, this is the operator. I request you to kindly come back and
again.
thank you for follow-up questions. We have the next question from the line of Abhishek Singhal from Perpetuity. Please go ahead.
Yeah, Hitesh, Namaste. Thank you for the question. I just wanted to get some sense around what is your initial feedback. It's been around 2 quarters, your injectable facility is now on board, and we have costs online. So what's the feedback from customers? Are you happy with the feedback you're getting? Like what you would have anticipated early on, the years to fill the facility, you feel confident to be earlier than that? So some color around that would be really helpful.
Sure, Abhishek ji. We have, got very, very good and very strong positive reviews from customer audits that have happened. And, we have already purchase orders against which we are manufacturing. Just because we cannot sell before the stability data is finished, those basically those manufactured batches are being kept as finished goods. So that's why we say that in Q3 the revenues will start to come as product by product, each product stability data is completed. So very strong, good feedback, very encouraged. Of course, the larger customers and the larger accounts will still take their own process, right, to approve a facility and to come in. So, it's a mix of, from a timeline perspective, it is, very much where we expected it to be. Obviously, we are not satisfied and we are always wanting to accelerate. So that process is on.
Secondly, one of largest peer which got recently listed, painted a very bleak outlook for the industry per se, that there is some slowdown in the industry and that there are some challenges and possibly they are ahead in the game as far as the peers, and peers will see the pressure in the second half. Could you add some color as to how do you see the industry panning out? Are you seeing early signs of fatigue out there for you guys, or you think and specific, this question is more toward the CDMO side of the business or the CMO side of the business, whether the current growth rate that you're seeing, you find it sustainable, at least in the near term or even from a longer term view, if you can provide some color.
Sure. See, Abhishek, first, as you know, the growth will differ based on how sizable a current player is. And among the listed players in our space, we are the smallest, right? So, we feel very optimistic, in terms of what we are seeing. And, that's why you will see that, despite the IPM volume growth being small, we have been observing this in the last 6-7 quarters now, that our growth is still going strong. Unfortunately, I believe that IPM doesn't cover some parts of the market like trade generics, like some part of institutional, like others. So very hard to say, very hard to comment, what they might be seeing and what we don't see any structural challenges. We don't see anything changing. We want to continue to strongly perform, and that's at least that's where we stand today.
On the dosage form, that in the previous question you all mentioned about open to acquiring different dosage form or like getting into it. Do you have any specific? Injectables was definitely a space. Is there any specific category that is of prime interest in your mind which you guys are actively looking at, or if you can provide some sense around that?
Sure. We have actually the investment bankers that we have asked us to show different assets for inorganic. Our brief has been to look at like ointments, one area that we want to grow in. Another area is soft gel. So we have hard gel capsules. Currently, we don't have soft gel, so that's another area. A third area has been, protein powders and, nutraceutical kind of dosage forms.
And hormones.
And hormones. That's another, very few players have hormone production capacity. So these have been, the briefs that we have given. And, so our main thesis is this, that each, of these expansions should help all of our three verticals. So we should be able to use it for CDMO, we should be able to use it for exports, we should be able to use it for our own trade generics. And that's how we believe that, the synergies will come through.
And any luck on the dossier acquisition for exports market, because that could also help trigger your, potential inspection either on the injectable side or something from the regulated market side, not US, but at least the UGMP or the PICS compliance. Is there any thought process around that?
Yeah, so we had updated Abhishekji, in the last call that we have acquired a few dossiers, and now that process of transfer is ongoing. So as we get success, we will definitely come back and update.
And one last question, if I may ask. So, like the first half, we've seen the entire costs come through for the injectable plant. both below the EBITDA on depreciation front and also on the OpEx side, and zero revenues, right? So which quarter, I know you start in Q3, but do you think by Q4 of this year or likely by Q1 of FY26, at least the drag that we are seeing because of the new plant, that goes off and we start seeing operating leverage play out, at least incrementally slowly? Which quarter should we be looking at on that?
So, Abhishek, I will request that we, evaluate the injectables business at the end of the financial year, because see, there is the OpEx, as we increase capacity and production, the OpEx also rises. There is a variation based on, the temperatures or outside temperatures, in terms of how much cooling, power consumption is there. So, a lot of variations to look at on a quarterly basis. I request that we have this conversation at the end of the year. Of course, we are totally committed and driving to, to bring in the operating leverage sooner rather than later. So, I'll request to defer this answer.
Got it. Thank you. Thanks, sir.
Thank you. We have the next question on the line of Rohan Vora from Envision Capital. Please go ahead.
Hello. Thank you for the opportunity and congratulations on the numbers. So first question was on the trade generics business. So we see that we've reached 40 crore a quarter run rate this time, and so the question was, is this a new normal? How does one look at it? I understand that there will be lumpiness given the nature of the business, and what would you attribute this growth to? The expansion on the centers that you are doing, the channel that you're adding, the feet on the street that you're adding. So just a color on what is being done right for this business, and how do we expect this to grow going forward? Thank you. This is the first question.
If you see for Q1, the number and the growth percent was a little lower, and people were asking, our investors were asking us if this is the new norm, and we said that let us not look at it quarter basis. We have to look at it a little more, So maybe you can look at H1, but again, is H1 a new norm? Very difficult to say. We are seeing good positive things going on. That we maintain. We have seen it. What is exactly going good? We have been internally, I would right now say that this is more driven internally. External market opportunity is anyway huge, right? That we have been saying, the government efforts also, and the huge opportunity that stays. So that is there. Internally, what things we are doing good is we are working on geographical expansion. We are working on increasing the number of stockists. Our product portfolio we have been increasing, and we keep looking for the areas of growth. We have been increasing our business development team as well. So we are working on all those factors. Sometimes, as you rightly said, the nature of business stays a little lumpy, and that's why quarter-on-quarter variations might be there, but we are seeing this vertical delivering a good momentum and growth.
Understood. And just the number of stockists, you had around 996 in FY24. So just a ballpark number on what is the kind of number we've added in the 6 to 7 months that have gone by?
Actually, number of stockists is a lesser important number in our view than the active stockists, because out of this 996 also, maybe a few might have become less active, and there might be 200 more that have been added, which are way more active.
Right.
I think, yeah. So that's how we have to look at it. At the year end, we will be sharing the exact number as well. But honestly, what we see growth is, of course, the distributor of stockists that got added in last 3-4 quarters now must have started giving the results. a bit. So that the same principle that we apply for CDMO customers applies here as well for the stockist.
Understood. And just a color on the API price erosion and how you are seeing that play out over industry level. So this is the second question. Thank you.
We are most of our business, especially CDMO, is open cost sheet business. So that's why a little bit impact might be there on the revenue number, but we don't see much of an impact on our margin numbers there. And API hit has already been there, and you have seen our revenue numbers. So in fact, going forward, everyone is expecting that to stabilize, right? So we don't see our business being affected a lot with that.
Okay, and are you also of the same view that the API price erosion more or less will stabilize going forward?
Yeah, we don't see, as it is, we are mostly domestically sourced, right? So, to the extent that there could be some, N-1 level of changes to intermediates, and that might affect API industry for domestic market in India, may be possible. Very hard to predict, but we, because we are not too much dependent on exports, we really don't see much of a issue. After the COVID period, a lot of domestic API manufacturers have stepped in, which is leading to some price erosion also. But we feel that this is now getting to a more or less stable regime.
Sure. Thank you so much.
Thank you.
Thank you. Participants are requested to kindly restrict your questions to 2 per participant. We have the next question on the line of Nitin Agarwal from DAM Capital. Please go ahead.
Hi, thanks for taking my question. Komal, 2 questions. One is A, on your capex. What capex should we assume for the next for 25-26?
So for 25-26, other than the maintenance capex, whatever portion of plant 6 is there, which, as I mentioned, we would be coming back by next quarter call. We don't see any other big capex requirement in FY26. So maintenance capex of 10 to 15 crores, that is generally there. That stays.
And any other expansions that you will? How much should we expect for the year in 25, for example, for the full year?
For FY25, Nitin, as I was saying, in H1, 48 crores spent, right? Annual maintenance capex you can consider of about 5 crores already spent, 5 to 7 crores more. So 47 plus 5, 52, plus whatever portion of plant 6 we spent in FY25 would be my FY25 capex.
Yeah, we are unable to give you a very clear answer on this because we are still, scoping what the layout will be, what will be the, the whole, cost over there.
Sure. And just a link part, with all the after the unit 6 comes on stream, and without that, what is the maximum revenue that you think the network can generate on the oral side at this point of time?
Within, we are pitching for 1,000 CR revenue with these 2, plant 2 expansion plus plant 6. We should be able to deliver a revenue of 1,000 crores.
And Komal, that takes you where? Given the current run rate, that probably suffices you for another couple of years. At what stage do you need to start to plan beyond Unit 6?
So, question is about, I think that the way we look at it, and this is an industry general rule also, typically, Nitin, when you reach a plant utilization of about 50-55%, that's when you start building a new facility. And in our, we are the way we think of building new facilities is to build for next 2-3 years, not for next 6 years, right? Because then if you build a very large facility planning for next 6 years, then your capex and your opex also becomes in that same way. So I think that when we reach, and it could be earlier or later, whenever, right? Whenever we reach about 45-50% capacity utilization of plant 6 and plant 2 extension, that's when we would think of adding another site.
Okay. And last thing, Hitesh, on the there is a lot of new product pipeline, which is rather patents getting expired in the domestic market over the next couple of years, especially in diabetes. So, particularly on GLP-1s, we don't have the capacity capabilities to handle GLP-1 manufacturing, right?
Yeah, currently we don't. Most of the GLP-1s, some of them are very, very complex products, but we are working with some developmental, labs who can help us, but it's still out there. It's not very sure whether we will be successful. But regarding the GLP-1s, because it's a very complex space, yes, we do not have the currently the capability to do it in-house.
And X of GLP-1s, how is the new product pipeline over the next few quarters?
Very strong. Actually, we continue to do, although the R&D expenditure may look, lesser compared to last year, but that is primarily because of the periodic nature of the expense. Which project has the clinical trial coming at what point in time, or stability batches and so on. So there is no change in terms of our portfolio planning or the richness of the pipeline or the kind of opportunity we are trying to look at in our key 8 therapeutic areas of focus. So that remains as is written.
And if I can squeeze in last one.
Mr. Nitin, request you to kindly come back in the queue for proactive questions. For next questions, please.
Sure, go ahead.
We have the next question on the line of Nishant Shah from Moneybee Investors. Please go ahead.
Yeah, am I audible?
Yes, you are.
Yeah, congratulations on the great set of numbers. Just wanted to understand one thing. You said that the volumes have, kind of stagnated in the industry. So for Windlas, what has led to the growth? What has ideally led to the growth in the last 7 quarters, firstly? And are we seeing any price hikes in any particular therapeutic area which has led to the growth? I understand, we are growing by entering into new geographies as well as having new dockets, but are we seeing any price hikes? I believe cardiovascular, the therapeutic area could be one place where, we are seeing price hikes.
So maybe see from our perspective, as I mentioned earlier, the stagnation in the overall volume growth of Indian pharma market, I believe, is little bit of a unfair number, because the AIOCD data that reports it, or IQVIA data that reports it, does not include a large portion of the market, which is the trade generics market. So that could be one of the reasons where volume growth still is happening, and we don't know it just because the data agencies are not counting it. Other than that, I still feel that, and I would reiterate, that we are at a size which is much smaller. Among the listed players, we are the smallest, right? So I don't think that there is a structural limitation in terms of where this growth it should max out or something like that. We believe that the Schedule M is leading to clients making better decisions about where they should source from. And there are more than 12 to 13,000 CMOs as per the market research that was published, some while back. So there is a huge opportunity even for this, upward movement where organized players should benefit, and I believe that also has some role to play. And finally, this is an execution story. Really, everything depends on how we gear ourselves, how our business development teams, operations teams, supply chain team, how all of that gears up. And that takes a long time to set up and execute. And we have been working on it for the last 2 years. And so I'm pretty sure that, those efforts have also a very big role to play in, getting us this growth. And I don't see anything changing, at least that's from where we stand. I don't see anything changing, but future's anybody's guess.
Right. Just a follow-up question. Are we seeing good traction in the trade generic side? Because I believe a lot of doctors now have started, giving or recommending. If suppose a particular patient goes to a doctor, they would, now they would not be very, they would probably not recommend it, but they would be very neutral about a patient using a trade generic. So are we seeing good traction in this space, moving forward? Because I still believe there's a stigma around trade generics. People prefer using branded generics over trade generics.
So see, you can definitely see the impact in our own trade generics, vertical. So we have been steadily growing very strongly. At the same time, whatever our customers, our CDMO customers, they may be selling their brand as a branded generic or as a trade generic, but we capture that revenue in our CDMO only, right? And we don't have any way of knowing how they are selling in the market, whether they are doing it as a branded generic or as a trade generic. So very difficult to comment on what you're saying. As a general aspect, yes, it should be making an impact, but very difficult to comment quantitatively.
But yes, we are seeing a very positive response and a good traction in TGX. Yeah.
Great. And I just have one last question.
Sorry to interrupt, Mr. Nishant. Request you come back in the queue for follow-up questions.
All right. Yeah, sure.
Thank you. We have the next question on the line of Miten Lathia from Fractal Capital Investments. Please go ahead.
Yeah. Congratulations, Hiteshji and Komal, on industry-leading performance. Just had one question around the injectables revenues. So we'd earlier sort of suggested that towards the end of fiscal 25 is when we should be able to utilize our injectables facility. Do you see any reason to change that, where things have progressed till now? That's my first question.
So first of all, thank you, Mitenji. We are currently utilizing the facility, and the facility is producing commercial batches. Those batches are essentially being stored in the finished goods store because they cannot be sold until the first batch completes 3 months of stability testing, and this is applicable for each product, right? So the utilization of facility has already started, right? The question is, what will be our ability to, revenue, right? How much will it be, within FY25 and then going forward? And for that is something that we have said that let's look at it at the end of the year, where we stand in terms of the injectable revenue. That would be the most honest, right way of looking at it.
Yeah. So net Miten, no change in what we have been saying. We are not changing any statement.
Yeah.
What we said, it holds true. In fact, there will be a small portion of revenue in Q3 as well, and Q4 there will be revenue. How much, we would discuss that after the year is completed.
And have we sort of quantified the impact of the operating cost on that injectables facility? Depreciation, you said, on of the data coming from injectables, but at the EBITDA level, have we, at the operating cost level, have we quantified what the injectables facility would have added?
Yeah, absolutely, Mitenji. We have complete, visibility and clarity around it, just so that, we are a cost-plus business in CDMO. So, disclosing, dosage form-wise OPEX is a competitive issue, right? So we don't want to discuss, those sort of things. But yes, obviously we are completely on top of it, and we are fully aware, what that impact on our own margin will be.
Appreciate that. So just to sort of derive from what you just said, given that the mix of the business has changed favorably and yet the EBITDA margin has not moved, suffice it is to say that the EBITDA margin would be.
Sorry, we lost your audio, Mithinji.
Mr. Mithin, your audio is not very clear. Could you repeat your question again?
Can you hear me, sir?
Yes, we can.
Now,
Yeah. No. So what I was asking is that given that the mix of the business has changed favorably on a YOY basis, and yet our EBITDA margin is flattish, would it be all right to say that but for the injectables facility, the margins would have been higher on a YOY basis?
Yes, absolutely. We would, that's why in my opening speech, I mentioned that the costs have come in, but the revenue has not.
Can we use that as a proxy?
Can we use that? Sorry, again we lost you, Mithin.
I'm sorry, I'm having a bad network. I'll connect with you. Thank you.
Thank you. We have the next question from Ashish Khurana from Man Capital. Please go ahead.
Good afternoon, ma'am. Good afternoon, sir. Thanks for the opportunity. Congratulations from my side as well for a good set of numbers in this environment. I am a bit new to the business, so the couple of questions I have are a bit directional in nature. So please ignore any naivety that you might find in them. Firstly, on the strategic balance between trade generics and the CDMO business, just wanted to view. For example, if a new capacity comes up, so we have these two lines, and they have their own advantages. CDMO businesses have probably more stable clients and all, while the trade generic business would give us better margins from what I gather from previous calls, and probably an opportunity to build in brand. So if we have to say allocate capacity or resources, if at all we reach such a point, so how do we decide basis our strategic priorities?
We do not say no to any business. We grow in all verticals as much as possible. That's the strategy, honestly speaking. Because as you rightly mentioned, all the businesses all the verticals that we have their pros and cons. There are things that we have to be conscious of, and there are things that really benefit us well. So how we look at it is we want to have capacities to cater to any requirements and more, and deliver as much growth as possible. That's how we look at all the three business verticals, honestly speaking.
Yeah. So basically, what you're saying is that the trade generics business is not constrained by capacity or resources. It is growing as it should grow basis our channel strength and the overall demand, right?
Yes, that's right. Because there is also some internal discipline that we have maintained in terms of the credit period that we allow for the new stock is added, and the invoicing holds that have to happen in case of delay in collections, etc., etc. So aside of that, there are no constraints in terms of growth. So capacity surely not a constraint.
Noted. Second, on Schedule M implementation, so there is some uncertainty in the industry as to whether that first week of Jan deadline would be adhered to. So probably you won't be able to comment on that. But from your clients in the CDMO business, do you sense that there is an intent now, irrespective of whether that deadline stays or is postponed? Is there an intent to move towards bigger players from the smaller players? And is there a sense that this is the lay of the land going forward? If not now, then at some point in future, that revised Schedule M would be implemented, and it is better to shift to bigger players.
Yeah. See, even about 2.5 years, 3 years ago, when we got listed, if you see our presentation, we were already predicting this. The Schedule M was going to be passed, and we were categorically stating that there will be an impact. In a fragmented industry, regulatory and quality pressure will lead towards more organized players. And our job and focus has been to improve quality, to create capacity ahead of time, and to ensure that we are able to receive the opportunity in terms of our outreach, in terms of our product portfolio, and all of that. And we believe that this is a structural change and will continue. I do not see any reason why there could be any movement back towards poor quality acceptance or things like that.
Got it. That's good to hear. Lastly, ma'am, on the trade receivable side, there was...
You kindly restrict your questions to per person.
Got it. I'll do that. Thank you.
Okay. We have the next question from the line of Ankit Gupta from Bamboo Capital. Please go ahead.
Yeah, thanks for the follow-up. So my first question was, one of our larger peers is setting up a huge capacity in Jammu with a capital outlay of around 450 crore. So, from a competition perspective, how do you see, some of your peers putting up such large capacity, and how does it impact a relatively smaller player like us, in terms of getting new projects and products from our customers? Does it impact that you might have to lower margins if they want to bid a bit aggressively for some of the new products?
So, Ankit, I will answer that in two ways. The first is that whatever we understand, the capacities that are being put in Jammu by this player are of dosage forms and products that we do not play in. So we are not present in injectable antibiotics, cephalosporins, penums, or any of those. And so there is one is a clear separation of dosage form. But second, which is a more important point, right? I think the space, if you see, is moving towards more organized players. And there are 13,000 contract manufacturers in India. Does India need 13,000 players? I don't think so, right? No other country in the world has, this kind of a fragmented contract manufacturing industry in pharma. So my sense is that there is ample room for all large players and even other large players to emerge. It really depends on your capabilities, your access to capital, and having a disciplined approach to building the product portfolios and executing. So my sense is that there is ample room to grow.
Sure. The second question was on the trade generic front. We have seen a very healthy growth in the second quarter, and we have always been very bullish on the segment, stating that our size currently is minuscule compared to some of our larger peers which have a top line of 1,500-2,000 crore as well. So do you think, I'm not asking for a timeline, but do you think this segment itself can become a 500 crore plus kind of segment over the next few years?
Yeah, absolutely. Why not? Absolutely. Right. There is no reason why this segment should stay a small one. I think that the opportunity is there, and the best part I feel is that the opportunity will be tapped by formulation manufacturers like Windlas, because that's where the best, the closest match is with regards to the market space. So I do not see that even 500 to be a limitation there, right? So absolutely not.
Thank you. Thank you very much, ladies and gentlemen. That was the last question for today. On behalf of Windlas Biotech Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
Thank you very much.